Good Monday morning. Welcome to Connect, the California MBA's weekly podcast featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Dustin Hobbs, Communications Director here at the California MBA. We got a great guest today. I'm excited to jump into some legal and regulatory issues with him and find out sort of what's on tap for 2021. But before we do that, let's thank our sponsors over at Accelerate. Accelerate is the leading mortgage lead management, CRM, and engagement platform that helps lenders close more loans by increasing efficiency gains across sales, marketing, operations, management. And they recently, this last year, announced the first of its kind mobile app. This groundbreaking mobile app features full lead management, lead distribution, click-to-call, inbound call routing, first call automation, and two-way compliant text messaging, and provides access to critical loan information without having to use a laptop or log into your LOS system. It also empowers loan officers by intelligently distributing leads, managing pipelines, prioritizing your day, automating best practices, and personalizing the borrower's journey, all from the mobile app. So for more information or to catch a demo, you can visit accelerate.com or call the number listed in the description below. You can also find Josh Friend on LinkedIn. He's very active there, and I'm sure if you reach out to him, he'd be more than happy to set you up with a demo. So before we get in the conversation here, I want to toss it over to Susan Milazzo, our CEO, for this week's update. Susan?
Thank you, Dustin. Hi, this is Susan with the California MBA. And this week, I'd like to talk with you about a webinar that we're hosting along with the National MBA, as well as the Mortgage Bankers Association of New York. We're going to be talking about commercial real estate finance and the role that the banks are playing in that segment of the industry. We're also going to be talking about how the CREP industry has navigated the pandemic and what their outlook is for 2021. The moderator for this session will be my good colleague and friend, Mike Flynn at the National MBA. And the panelists will include Cody Sharp-Boris, who's Managing Director and Principal at Slack Capital, and also a member of the California MBA's Board of Directors. So if you're interested in what the outlook is for the commercial finance industry next year, this is the event that you want to participate in. It's happening on December 8th, and we hope that you can join us. That's it for this week. Back to you, Dustin.
All right, thanks, Susan. Now let's jump right into the conversation here. I want to welcome in Mike Flynn. Mike is of counsel with Buchalter, and Mike is also the incoming vice chair of the California MBA's Legal Issues Committee. So welcome, Mike.
Thanks, Dustin, and thanks to the CMBA for inviting me to participate. This is a great program, and I'm thrilled to be a part of it. Thank you.
Yeah, welcome. And so let's start at the beginning, like we always do. Let's find out what's your background, Mike. How'd you get in the legal field, and what kind of led you to where you're at now at Buchalter?
Well, I got in the legal field basically because I majored in political science in college, and when I was a senior, I really didn't want to go to work, so I took the LSATs and went to law school, and I went to Duke, and then moved to California because my mother had moved out here when I was in law school, and spent 17 years in Los Angeles and Beverly Hills as a litigator. Ended up litigating mostly real estate, mortgage, and title insurance matters. And from there, went to Chicago Title in Chicago, where I was in charge of the lawyers managing all the company's litigation. And then I went to World Savings Bank up in Oakland, which many folks listening in I hope will remember, where I led the mortgage servicing lawyers. And then I got a political appointment at HUD, where I ended up being eventually the acting general counsel at HUD during the financial crisis. I was there from 07 to 09. Did a lot of work on TARP and work on the mortgage bailout issues, and was the chief counsel to the oversight board for the Hope for Homeowners program. If people remember that, that was sort of a congressionally created precursor to HARP and HAMP. And then after HUD, I went to PNC. They had acquired National City Bank, and with it, National City Mortgage. And I went to PNC to be the general counsel of the mortgage operations and built out a mortgage legal team there, and started going through the foreclosure look-back crisis, PNC being one of the entities that had the independent reviews. I then went, unfortunately my career is very lengthy, but I'll have to keep going. I went through, I then went to Flagstar Bank as their general counsel, Flagstar being a large national mortgage lender and servicer. Stayed there for a few years as part of a turnaround team that came in after the company had accepted some TARP money and a new executive team came in. And then I went to Goodwin in DC, where I was co-chair of their consumer financial services group. And then we decided to come back to LA. My stepchildren, my wife's children, are in Denver and New Mexico. DC wasn't a good site for our personal life. So I knew folks at Buchalter, and I knew the reputation of Buchalter, and how involved Buchalter is in the mortgage and consumer world, called them up and we got together. And I came out here about a year and a half ago, and I've gotten very active in CMBA and other areas. And so I focus a lot on mortgage, obviously, mortgage regulatory, mortgage risk oversight, that sort of thing. And that's the gist of my practice.
Yeah, well, I'm curious. You've got an extensive background there, especially in some of the more interesting times in the industry in the last 20 years or so. What would, I mean, this is sort of off script here, but I'm curious, what was a bigger challenge, working at HUD through, like, in the heart of the financial crisis, or sort of at these companies afterwards, sort of picking up the pieces and rebuilding the practices?
Well, that's a really interesting question, and I really hadn't thought of it. I'd have to say that they were both hard, but they were hard in very different ways. HUD was hard because what we were doing was largely new. It had never been done before. There was no legal protocol. For instance, could you take the language of the TARP statute and say it applied to injecting cash directly into banks instead of buying truly troubled assets out of the secondary market? We were originally at HUD modeling how to buy things out of the secondary market through FHA and Ginnie Mae, and then when Treasury and the Fed wanted to go a different direction, we of course switched gears. But determination had to be made whether that was appropriate legally. That was, that took some hard thinking and serious analysis by some very intelligent people in these agencies. So that was a different kind of challenge. And then setting up the Hope for Homeowners program was different because there are always sort of policy and political in the best sense, overlays to any federal program, including what FHA does. And so those considerations had to be built into everything. So that was a very different kind of challenge. Going to PNC and Flagstar was quite different because there it became largely a difficult, ever-shifting operational environment where, particularly with HAMP and HARP, as you recall at the beginning, the rules on those programs changed every few weeks, and sometimes ex post facto, after the fact, there were reinterpretations of things that had been going on for a very long time, including SCRA interpretations by the OCC that they had previously allowed and then changed their minds. That required a lot of nimbleness in those companies, and I think for any lender, particularly the ones going through the foreclosure lookbacks, they had to have a lot of coordination between operations, compliance, risk oversight, and legal, because that was the point where they all meshed together. And I think it really challenged a lot of companies. And I personally found it quite interesting, but hard work to have comfort that I was going to bed at night and we had sealed off all the problems we could think of. So I'd say in that sense, they were both really pretty difficult jobs, but quite different.
Yeah, well, and I mean, like you said, I mean, you're breaking ground essentially in both areas, and
yeah,
not much precedent for either of those. So let's fast forward to this year. This year has obviously been another one of those years that's been a challenge, to say the least. So what are you hearing from your lender clients right now about maybe their biggest challenge that they've had this year, and maybe what they anticipate in the coming year?
Well, I think one challenge they've had obviously is just the operational and risk management issues involving the different moratoriums of foreclosure eviction moratoriums, the various Freddie, Fannie, investor guideline changes on underwriting. Do you need to have appraisals? When do you need appraisals? All the sort of ground rules have moved, and so they've had it's an operational and then risk management issue for everyone to get that right. I don't think it's particularly legally difficult. The rules are well laid out, but implementation has been a real challenge for people in a time when their employees are facing a lot of personal uncertainty. So I think in that sense, it's been difficult. I think right now they're looking at what will happen with the new administration and I know we're going to get this later, the CFPB and other agencies, and what does that mean? And they've also faced some issues this year, I think, just because of the interest rate environment has been so favorable for borrowers, for refinancers and purchasers, that volumes have gone way up, and that's always a stressor, a good stressor, but a stressor on these organizations.
Yeah, right. I mean, the lenders I've talked to this year, yeah, I think you're totally right. I mean, it's a good problem to have, but it doesn't mean it's not a challenge to keep, while everyone's working from home and these different scenarios. Then you've got.
If we've learned anything from the past 10 years, from the last crisis to now, it's that regulatory agencies have little tolerance compared to a generation ago for operational mistakes that affect consumers adversely, particularly consumers who are in economic difficulty. The programs are designed to protect those people. They expect it to work. And so lenders really do face higher levels of challenge in terms of getting their operations right. That I think they all know that. They seem to react immediately that way. They get the issue, but it's an operationally imposing issue.
Yeah, no, I agree. Well, let's, so, I mean, at this point, it appears that, I mean, obviously there's still like recounts going and various legal challenges in several states, but it appears at this point, as we do this recording here, that Joe Biden is going to be inaugurated as the next president come January. So how quickly do you think, just from a mortgage banker perspective, how quickly do you think we're going to see a maybe different approach from either the CFPB or other regulators?
Well, first of all, as to other regulators, I'm not sure because we don't know what's going to, for national banks, we don't know what's going to happen with the OCC. If President Trump follows through with what he said the other day about nominating, and if the Senate pushes through the nomination of Brian Brooks as permanent controller, that would be a very different outcome for the OCC than if President-elect Biden does take office and then makes his own appointment. Now, the OCC is not normally a leader in this area, but they do regulate people in this area and examine them. So that would be of some interest. I think the CFPB, where you'll see changes very quickly, I think, will be in their internal examination protocols, and perhaps not the written protocols, but probably the spirit in which they come in and examine people and deal with complaints and problems. I think they'll, that's an agency that still has embedded in it a sense of how aggressive it was or perceived to be under its original director. And I think that's probably a fairly easy thing for them to turn again and start to resurrect. So I think you'll start seeing them fairly quickly in that regard. I don't think they can quickly rush out and suddenly launch a bunch of enforcement actions. They have to go through processes. But I suspect where you'll see things are things that are approaching decision points in enforcement examinations or enforcement actions or negotiations over consent orders. You may start fairly quickly seeing the CFPB taking a more, I don't want to say aggressive, it's not the right word, but
More active, yeah.
A stronger position perhaps than they may have. Although I don't think the CFPB ever lightened up as much as some of its critics claimed it did under the Trump administration. They were still doing enforcement actions and different rules. It will take them a while if they want to undo some of the rules the Trump administration has put in place, or some of the rollbacks of rules the Trump administration has put in place. That's going to take a while because you have to go through the whole rulemaking process. They're serious people that are going to be coming to CFPB, whoever they are, and they're going to not only follow the processes in order to follow the APA, they're going to want to get it right from their perspective. So they're going to take their time, I think, and do it right. So that will take longer, I think. The other areas where I think you might want to look at least at the federal level is, what happens with FHFA and Freddie and Fannie. There'll be a new director of FHFA, no doubt. In spite of what the FHFA did this week with the new rule about capital requirements, questionable whether they can actually roll Freddie and Fannie out of their conservatorships before January 20th. So if they're still in conservatorship, or even if they're not, FHFA is likely in the short term to continue doing what it's doing, I think, regarding moratoriums and protections of consumers facing the COVID crisis. And probably long term, perhaps a bit more of a pro-consumer focus on some of the programs they ask Freddie and Fannie to implement or tweak. But we'll have to see how long that takes to filter through. But I think it's worth keeping an eye on. And you asked about other agencies. I think the more assertive, if that's the right word, position we expect the CFPB to take will probably filter into some of these state agencies. We've seen a lot of states, including California, take a more aggressive position the last few years because of their perception that the CFPB wasn't doing as much as it used to. Some of these states have stepped up quite a bit. I don't think that will disappear. In fact, I think they will probably have the capacity now to coordinate more with the CFPB and do more in that area. Perhaps, start turning over some of their investigation information to the CFPB or vice versa. So you may actually see these state agencies getting more, I don't want to say emboldened again, because I don't think it's an us against them situation, but more active in what they're doing in terms of consumer protection in the mortgage space.
Yeah, well, I mean, specifically to states, is there something specific that you think mortgage bankers should be keeping an eye on, maybe from the sort of newly, I should say newly minted, but it's more of a renamed Department of Financial Protection and Innovation here in California?
Yeah, it's interesting. I've talked to some clients, mortgage lending clients, who told me that as background, of course, the statute that created or reconstituted the Department of Business Oversight into the Department of Financial Protection and Innovation said that the new UDAP requirements under the new statute and the new registration requirements applied to entities that were not licensed under the traditional DBO regime. So presumably in California, mortgage lenders and servicers are probably already licensed under these regimes or should be. So they might think the rules don't apply to them. But there's a couple of issues. One is some of my clients have said they're seeing a more consumer protection oriented focus already from DBO, now DFPI, in their in examinations and interactions on customer complaints and things. It's not surprising if part of the agency is being charged with getting much more aggressive about these previously unlicensed, fintech companies and other servicers and service providers that clearly the state was worried about, then that ethos will no doubt push through the entire examination enforcement area of that agency. It's just natural. So of course it's gonna happen. Plus, California is a leading state in the area of consumer protection. That's growing and it's going to continue to grow. The other area that I think is interesting about the DFPI in particular is, although the new rules apply only to these previously unlicensed entities, a careful reading of the statute says that if one of these newly covered service providers is providing services to a covered entity and it's in violation, the covered entity has problems, I don't think that applies to currently licensed entities, but it does create a problem for them in the sense that if you're a bank and you're partnering with a fintech company that's now licensed, if you're a lender now using a platform provider that for some reason wasn't previously licensed but now is, if they are hit with one of these broad UDAP type analyses from the agency, you have vendor management and risk oversight issues internally that you need to be building out to make sure your vendor management oversight is keeping an eye on those people, because agencies, as anyone who's gone through this kind of thing knows, agencies do not like it when they examine a licensed covered entity and discover that its servicers or its third parties that it's using have been in violation of the law. So I think it creates not a direct liability under the statute, but a regulatory compliance issue for these institutions that I think people may not have been focusing on yet.
Yeah, no, I think that's really good advice for folks right now. I think that's really good advice. So if for folks that maybe aren't familiar with California's legislative cycle, we just kind of finished our legislative season here recently. Governor Newsom signed bills into law here in October, and most of those bills either took effect immediately or will take effect come January 1 here. So of those that were passed this year, and there were a bunch, what do you see maybe as having the biggest impact in the coming year?
Well, I think short term, very short term, of course, the restrictions, the continued restrictions on evictions following foreclosure, and the ability to bring foreclosures and the ability to collect rents for lenders that have taken back or have REOs but have tenants, or if the restrictions on foreclosures themselves lift and they're able to get a property somehow through a trustee sale or other foreclosure mechanism, they're going to have trouble evicting people and have trouble collecting rents for the period in which they couldn't evict them if they don't. And even if when they are able to do so, because the borrower was defaulted because of an at-fault issue, which, as the statute calls it, which would be something like collection of rent or committing a crime on the premises or something, or failure to pay rent or committing crime on the premises. Even if you have that, you've got to jump through a lot of hoops to be able to do it, a lot of proper disclosures. And I don't think the courts are going to be lenient about failure to have the disclosures done properly. So it's another operation. All these things keep coming back in the modern world these days to operational and risk management issues. And there's an example of where you have to get your processes right up front, or you're not going to be able to capitalize on what you should be able to recover. But the statute, Dustin, I'm actually more interested in, that I think is more interesting, is the Senate Bill 1079, which, for those who don't know, created a new twist on the trustee sale regime here in California. Traditionally, a trustee sale is held, the high bidder prevails if they can show proof they have the money to pay the bid. via cashier's check or something else. And then within 15 days, the trustee is to transfer title to them. This new statute provides that for single family 1 to 4 unit properties, if certain select parties step forward within 15 days of the sale, and those can include a tenant in the property, a third party who submits a non-binding statement to the trustee that they intend to move into the property, I believe within 60 days, and will live there for 12 months, certain designated state agencies, or certain types of third-party organizations, nonprofits essentially, that are engaged in the area of affordable housing creation and preservation. If those, if any of those types of entities notify the trustee that they intend to bid, the trustee does not transfer title to the high bidder 15 days after the sale. It has to wait
this is after the sale.
30 days. It extends it out for 45 days now to see if those parties come in. And if one of them does, they get the property. I think, Justin, you and I talked about some of these issues last week ourselves. This creates a whole slew of uncertainties and interesting questions, such as, will there be many people who claim they want to buy the property to live in it, or will many tenants step up under this regime? Because how do you get a loan? You still have to bring the bid in to the trustee within the 45 days, bring the actual cashier's check, certified check, cash, whatever it is, to establish the winning bid. But how do you do that for a tenant or potential normal residential buyer who's going to live there? Those are not investors. Those are ordinary consumers. And banks are not going to lend mortgages when you don't have title to a property. So you'd have to get a loan in the full amount, at least some sort of bridge loan. Not everyone, particularly tenants, are going to be in the position to get that kind of credit approval. So it's not clear how much help for affordable housing preservation that side of the bill is. What's going to be more interesting is, will the state at some point start funding some state agencies to step in and become participants in a meaningful way? And will there be third-party NGOs that do this? And is it possible, something I was thinking the other day about is it possible that some investors will see that as a play where they team up with these NGO type organizations to create a market here? And if this becomes a reality, if there is some significant amount of postponement of trustee sales, once we start having sales again, and I should add, this is an issue because, of course, fairly soon now, particularly if the vaccine works, foreclosures are going to reappear. And they'll probably reappear in greater numbers than we were having before. So it's going to have heightened scrutiny and a heightened effect on the economy and on ordinary people. And if, in fact, there is any sort of significant amount of this type of delay bidding that extends foreclosures out, how will lenders react? Because it creates a lot of problems. How much should they bid? How much will the usual investors that come in and bid on these kind of properties, how much will they bid? How much are they willing to bid out on several properties? Will they just bid ad hoc and hope some of them hit? And if they end up having bid on too many, they walk away from some. And will they price differently? Will they price lower? Will they price higher to drive away these third parties that now have the right to extend this? We don't know. That is a strategy. You could bid high, hoping that no one then submits a claim they're going to outbid you, but that's also dangerous because they might. And what banks do, and then the risks banks and those kind of investors have, and how they factor that into the bidding of the extended extra 30 days the property remains in the borrower's title. You have increased likelihood of nuisance, damage to the property, theft, break-ins, fires, all sorts of things that happen to properties while there's possibly someone there who owns the property who no longer has a big equity stake in the property and wants to preserve it. And in that case, what does that do to the bidding that banks do? Are we going to see decreased bidding amounts from everyone on these kind of properties? And will that really help preserve affordable housing, or will it move other investors to come in to try to grab up these cheaper properties? We're going to have to see how it plays out, but I think their intentions were clear here. They thought this would be a good way to help preserve affordable housing, but I think it's going to create a lot of interesting dynamics and probably unintended consequences. We'll have to see how they shake out if this statute gets any traction at all.
Yeah, it seems like it could almost create a scenario where you're, creating games of chicken between investors and these NGOs and stuff.
Yeah,
it'll be interesting to see how that plays out. So on a related note, where are we at with the residential eviction moratoria, and what are we likely to see in the coming year?
Well, there still are, you have the Freddie Fannie foreclosure moratoria and eviction moratoria, which right now are only extended through December 31st, I think, if I recall correctly. And whether the current director of FHA is going to extend those, who knows? But if he doesn't, and the vaccine hasn't been widely distributed by January 20th, which of course it won't be, I think you'll see whoever gets appointed as the head of the FHFA and nominated, if the Senate will nominate them fairly quickly, which I suspect will probably happen, they would likely, do that again. Or Freddie and Fannie on their own may do it because, if states are imposing eviction moratoriums, it's not clear what good a foreclosure does if you can't follow up with evictions. So in many instances. So I think that's an issue. The states, particularly in California, local jurisdictions have the authority to, under Governor Newsom, to have them in place now. I'm sure to the extent they need further authority to go past the first of the year, if the pandemic is still in place the way it is now, the governor's obviously going to extend that and give them the ability to do that if they don't have it already. So I think you'll see those extended. You have the statute, AB 3088 we just talked about, that has limitations on evictions and such. That's going to slow things down. So my read of it is, until the vaccine has taken effect and returned the whole economy, not just sort of the macro high level economy, which seems to be doing pretty well, but there's an awful lot of individuals who aren't doing well. Small store owners, people who worked at smaller companies, people who got laid off. There's a lot of unemployment, sort of, that may not be reported, a lot of partial employment, a lot of people who are having trouble making ends meet, and a lot of people who had to do forbearance, and we'll probably see more of that. So I think we'll continue to see foreclosure moratoria and eviction moratoria for a while, and probably only get unwound gradually, sort of subset by subset, I would think, to protect people who are most needy. But I don't think we're going to get back to a normal foreclosure eviction situation. If that's an idea of normal, I don't know. That's a strange way to phrase it. But I don't think we'll get back to what had been before for quite a long time now.
Yeah, I think that's right. So, I mean, based on all that we've talked about here with all the regulatory stuff at both at the federal level and here in California, what's maybe, if I'm a lender watching this and I'm, sort of getting, it's almost like a fire hose coming at me, what's one thing that a lender can do right now to protect their business and maybe mitigate this liability and regulatory risk?
I think the first thing is take a look at your risk oversight, compliance implementation, rule implementation processes. Verify they work. Your regulators won't be happy if you get it wrong and you haven't really made sure your own processes of that higher level work. And then go down a level and take a look at your processes on these specific operational questions and make sure they work. And then something else I've seen that people may not be focusing on is a lot of these questions lenders are getting, and particularly servicers are getting, but lenders too in some underwriting situations, on evictions, moratoria, and more importantly, what are the various types of deferments and forbearances that are allowed and how do they work? A lot of that is new to the servicers, at least in the bulk that they're seeing them, and the specifics of some of the programs. And they probably got people on the front line operating these call centers that are fairly inexperienced in this area. They need to take a hard look at their call scripts and the question answer call responses that people are allowed to make, and make sure they are accurate. And as these rules start changing, get those changed immediately and train your people, because I think that's an area where you could end up with real problems. Someone ends up being told, they're not entitled to a forbearance when they are, because the call center person read the wrong answer or something. Those kind of things happen, and they're understandable. It's human nature. All systems fail at some point, but this is an area where failure probably won't be tolerated.
Yeah, it seems like something that you could easily overlook, but good advice to maybe check on that now. Use the next couple of months here to do that before the next year really kicks off, especially if there's a change in administration and change in focus from regulators. So we've got time for one more question here, and this is more focused on the advocacy side of the piece, which both the California MBA and the National MBA have been hard at work the last year or so, working through a lot of this legislation. So from your perch there, how crucial is the industry's advocacy efforts right now? Again, both at DC here and in Sacramento.
Well, I think in Sacramento, what you've been doing is, and other groups, is hugely important. We saw it, the legislature in August and September rushed to implement a number of bills they thought were absolutely necessary before they went on a session. That led to a lack of hearings, very little time for interested parties to educate legislators on the issues. And for instance, on the bill that created put in new requirements for how COVID-related forbearances and COVID-related post-forbearances are to be treated, they don't necessarily create new obligations for most of our audience members because they were already covered by federal. It's basically you have to follow certain federal rules. They were already covered by Freddie, Fannie, the TRID rules, and everything else. But it did provide a sort of a new quiver, a new arrow in the quiver for regulators to accuse people of yet something else. And more importantly, my understanding is originally it was much more specifically designed to cover those kind of entities. And similarly, there were issues initially about the extent to which the new Department of Financial Protection and Innovation, the new licensing regime would cover the previously licensed banks, mortgage lenders, and servicers. And my understanding is that CMBA played a very significant role in getting some safe harbors and other things built into that legislation that made it operationally clearer what the boundaries were for your constituency and to perhaps build in some meaningful protection for them. I think on the national level, you're going to have sort of the same thing, but on a much longer time frame as the CFPB starts looking at possibly redoing some rules and asking FHFA, possibly Freddie and Fannie and others to redo rules, or not asking FHFA, but if FHFA follows that idea and starts looking into rules. But that's a longer term play. I think there's a need at the federal level. The CFPB is going to have some new people in some fairly senior positions, and perhaps some people who've been there before but have been out for a while. And education is always important for those kind of people. When I was at HUD, I didn't mind lobbyists coming in and talking to us. I always learned something from all sides, of whatever side the lobbyist was on. You always learn something and learn about key issues that you then have to explore. That's your obligation. And so I think getting in front of them and working with them will be really helpful. It may not get you the full result you want, but it can certainly keep things from going off the rails and perhaps get some consistency in long-term approaches. So I think it's really important that the DC aspect of this continue as well.
Yeah, no, I think that's a great point you make about education. I think when folks hear advocacy, these organizations like us and the MBA do, you think, more just advocacy, but not necessarily the education portion of it, which is huge. That is, I don't want to say the majority, but that is a huge chunk of time that our lobbyists spend educating the lawmakers who, again, they're dealing with the very intricate nature of some of these transactions, and they're not mortgage experts, obviously, and they would admit to that. So it's important that they do get educated. So
look, there's a reason why lawmakers have large staffs and allow educational programs of that type, because they're dealing with every aspect of life in California. Just to say California, for instance, you're right, they can't be mortgage experts. They're not experts on most things they touch. And even if they do take a focus on mortgage, they very rarely have had either an in-government agency enforcement perspective or, more importantly, an industry-related perspective. When I was at HUD working on the 08 RESPA reforms, I was surprised when I first got there that most of the people involved didn't have those kind of experiences. And it has an impact. Those people, they have to get educated. And so what you're doing is really quite important.
Yeah. Well, hey, Mike, really appreciate the time. Great conversation. I think we could have gone on a lot more. I really enjoy, chatting and yakking about what's going on in the regulatory, legal, and legislative world. So again, thanks for your time. Appreciate it. Look forward to working with you again this year, coming up with our legal issues committee.
Thanks, Dustin. I look forward to working with you, and thanks to the CMBA again for letting me participate in the program.
Yeah. Well, and if you enjoyed the conversation here, make sure and subscribe to us here. You can subscribe on our YouTube channel. You can also find us on Apple Podcasts, Spotify, and SoundCloud. And we're actually going to take next week off. So hope everyone enjoys their Thanksgiving break with their families and enjoys a safe time there. And then we'll see you next time on Connect.